Yeah. Oh, sure. Yeah.
There we go. All right, so I'm Peter Pomeroy. I'm in a team with these fellows. I'm in San Francisco, and all right.
Yeah. Awesome. Yeah. Here from Seattle. Henry.
I'm from Los Angeles.
James McCurry. I'm also from Los Angeles, but I'm literally on the border of Orange County as well. So I'm in like 2 counties at one time, but Los Angeles for most parts.
Yeah, it looks like we have a few from few Californians join us here as well. Yeah. So from Davis.
My name is Yan. I'm from New York, New Jersey.
All right. The Boek and Vivek. I think they're on mute. So.
Oh, hi, this is Boek. I'm from Bellevue, Washington.
Right. Washingtonians. Awesome. All right. All right. Why don't Vivek, you want to tell us where you're from? Or I guess we'll have the panelist intro as well, too, so we can talk another time. We don't. So awesome. All right. So I think we'll get going here a bit. So let's see. Okay. So today we'll be talking about basically COVID-19 and its impact to real estate and the economy, and if there's any risk and opportunity. So we are gathering together. Many of us are graduates of the Multifamily U boot camp, and that's how we meet and learn each other. We learned tons and tons from that boot camp, and we basically want to also share some of the knowledge and also network with other investors or just anyone who are interested in real estate. And so we have lots of people from different areas, and I guess the virus really didn't stop us from meeting, because we've been meeting one webinar, so it works out for us. But actually it was Boek's idea when we were first going to say, we're just going to do it in Seattle, and it was probably mid to late January, and Boek foresaw some of the news that coming off from China. He said, well, let's maybe do that on webinars just to be safe. And look at me how today in March, we're in the peak of the virus here in the US. So, all right, so I will also keep going. So this is a super casual, I call it a bonfire chat, pretending there's a bonfire in my background here. We're just going to talk about what we saw in the news, what we hear from other experts and other real estate influencers, and all these things are moving so fluid, and so it could be outdated the day after this is presented. So I'm not shy to talk about it, because I don't think anyone is going to have a completely bright and crystal ball. So anyway, so we'll just go ahead and introduce what this, we already talked about a little bit about what this group is about. And also we're going to introduce the panelists, and we're going to have a group discussion. So just talk about a little bit about the Multifamily University. I am just proud to say that I'm a graduate from the boot camp. Neil Bawa was the founder of Go Capitus, and he's also put together an educational arm for investor to learn how to do syndications, how to evaluate underwrite tool project, how to use the right tools. So I feel like I learned a lot. But the most important part is I made a lot of friends. So here's some of the people and I working with, or we're just actively doing deals or negotiating properties. So by the way, panelists, any opinions, or feel free to just chime in. Since I have the mic, and I'll just introduce myself a little bit. I'm from Seattle. I have a few single family properties in my portfolio, and I've been doing fix and flip, some wholesaling. I'm currently just actively finding and hunting deals, and I'm just glad that I'm not actually in a deal right now, but I still had to take a little hit on my 401k, so I'm not all unscathed from this. But all right, so why don't we go around the clock? How about Yan, you want to start us off?
Yeah, my name is Yan Yan. I'm from New York, New Jersey. So we are the center of the world.
That's right.
So nowadays, I've been thinking two things. So how do I manage the risk of my portfolio, not just real estate, or also other investment as well. On the other hand, once I have all the measures in place, I'm thinking what opportunity I should be watching for. So those are the two questions I asked myself recently.
Yeah. All right. How about James?
Yes, as James from Southern California. I've been involved in real estate on my own in some capacity for about 3 years now. A few limited partner investments in some retail stores, as well as multifamily units out in Texas. I've been looking quite heavily over the last 9 months in Florida and Texas and a few other states as well. But it's been interesting how we've always been having this cloud over our heads being like, well, when's that next time coming? Because we see the cap rate compression keep going down, down, down. So it's just such an interesting time to be involved in real estate because not everyone has gone through a full cycle before. So this may be the first opportunity for many people, including myself, to see how we can manage our portfolio and our business processes to weather that storm, however long it may be. So that's kind of what I believe we're all looking forward to in terms of opportunity, as well as fine tuning our efficiencies.
Yeah. Yeah, good point. Yeah. How about Peter?
All right. So yeah, Peter, I live in the San Francisco Bay Area. Oh, I moved you guys over here. My background, I've been in commercial real estate for about 20 years. In a whole bunch of different capacities in construction, as a broker, investment, development. Did the boot camp class, loved it, really loved Neil's analytical approach. So in terms of what I think is going on, my kind of 10-second elevator pitch, I think that there'll be really big opportunities to buy, but not necessarily because things will be discounted 80% or something dramatic like that. I think there'll be opportunities for equity investors, opportunities for operators. So both, on arbitrage as well as improvement. I think that the reason is that I think there's a lot of bad deals out there already, and this will just knock them out. I think that certain property types will get a hit, have a hit just from a valuation perspective, and then there's deals that'll have currently have just a hair too much debt and won't be able to survive, and then there's deals where you're just in the wrong product type. So because of that, I think doing what we can to get in touch with our investors in the U.S. and outside of.
Oh, did we just lose you, Peter? Oh, I think you might have a bit of connectivity issues. So,
Okay.
all right. Wild, let's see. Can I see him on the screen?
I see him on the screen.
Oh, okay.
I think he was actually just finished.
Oh, okay. I think you meant just finished. Okay.
My internet may have gone out, so just stick
All right.
with whatever you heard and imagine the rest was really quite good as well.
Yeah, that's very good, Peter. All right. Hey, Vijay, wanna go?
Hi. My name is Woo-jae Kim. I'm a physician working in Los Angeles area. I got involved in real estate by being a money lender to rehabbers. Now my focus is in commercial real estate, multifamily. And to all the listeners out there, I think there'll be a lot of opportunities coming up in the future. You got to really invest in education, networking, a lot of people, because it's through knowledge and network that you have access to these opportunities. So just want to really encourage all you guys. And one thing is that my boss told me that at our hospital, if things become worse, I'm a specialist, but they may ask us to work in urgent care. So we're all kind of getting ready for this. So just want all you guys to know that healthcare industry, we are getting ready. So so pray for us. Pray for everybody.
Thanks for a medical professional. Yeah, absolutely. So, Boak, you want to go?
Oh, hi. Yeah. Yeah, I'm Bowick in Washington. So I'm in a title industry. So in the past probably 17, 18 years, I actually spent a lot of time to provide a lot of training to my real estate agent because I have a licensed real estate instructor. So that's why I have an opportunity to talk to my real estate agent every day, almost nonstop. So now the market, because of the coronavirus, of course, many agents they are staying home at this moment. So they tell you the truth, they are worried about the market. So I personally also saw a lot of a lot of deal. They were pending, but end up the past 2 weeks, the buyer back out from the deal because they are worried about not only the virus but also the economy, the market. So let's pray for that. We don't know how's the situation will going because today that our country, our America, become the confirmed case become the number one in the whole wide world. Although the figure from China is not true, but if compared with other countries, we are not that good in the situation. So that's why my agent actually they told me many investors they are actually at this moment they put on hold on their investment. For those big projects, they already make a commitment. They are actually thinking how to back out from those projects. So because they don't know what's going to happen, especially the economy. So we are in a really uncertain time.
Yeah, unprecedented.
Yeah.
Right. Okay. I think Vivek might has to be on mute because if he can speak, but I think he might have baby duty.
Yeah,
So.
he actually just texted me saying that unfortunately the baby is calling his name, so it's hard to say no to that.
Yeah, that's all right. We'll go back to him later. Okay, so all right, why don't we keep going here? Oh, I switched to audio only because my bandwidth also is a little choppy, so preserve my bandwidth as much as I can. Did I hear someone speaking? All right. Okay. So, for those who might not have the chance to watch this presentation from Neil on Tuesday, he was really informative, and he talks about some of the topic on the right side, kind of the impact to our life, the lockdown, the recession. Are we in it? Looks like the data we are already in it, even though maybe I think it needs to be certain months before. They announced it's formal recession, but from the data, it seems like we're already at a recession, and some of the impacts on the different asset class, not just multifamily, but what's doing in stock, in hotel or in self storage and so forth. So this is a really good, informative presentation, and if you haven't got a chance to watch it, you can, I think, go to his website, which was coronavirus real estate, really catchy name.com. So we're not going to go talk about too much of what he's already said, but there's a couple topics that we do want to bring up. Well, I do want to also talk about just an update on where we are going as far as where the virus is going, what the economy is doing right now based on the data we've seen so far. And there's not a whole lot of data. Most of the economic indicators are at least a month, behind. So we'll start watching the late February or March data. I think just today we have the initial jobless claim. That's number, it's huge, right? So we'll be seeing probably more of that information coming in the next few days or weeks. Also, what are if there is a consensus, what are the other people are saying? What are the analysts, economists, or people who are actually actively doing the deal are saying? What are their outlook? Also, maybe getting to more personal, what are ways for yourself, you to protect your own investments, or what other experience indicators or people who have gone through a recession in the past, what are they saying? And also, are there opportunities ahead? I think Jay talked about it a little bit. James talked about it. We're still doing deals, still doing underwriting, but what are you looking for in the next coming months? So, all right. So I got this today when I was listening to a HI risk management call, and it just will show about the cases, and it sounds like this case already number that on the left side in the U.S. cases are already outdated. I think we just overtook China and Italy, 10,000 cases a day. So we're number one. But also, what this slide is showing is that just the number of cases don't tell the whole story. Is also have to look at the case to death ratio. In fact, you can see that Germany is pretty high. That means they've done a lot of proactive testing, and the more detection and testing they do, it helps mitigate some of the knock-on effects to from shutting down the economy for other things in the way. So, in fact, I think we heard in the news that the U.S. is increasing the number of testing, which is a very good sign. But at the same time, it's also we see 10,000 cases, right? And this exponential trajectory, which is still very concerning. Okay, so on the next chart, this is showing the total death, the cases and total death per million. So USA is actually still relatively low compared to some other countries like Italy, because I think our health system is largely still intact, although it's really tested right now. Cases in New York are growing so much exponentially right now. So I might just leave it at that point. But this is a chart I want to show because I think it shows kind of what the government is doing and how we were able to control the virus. You have all maybe heard on the news about flattening curve, and this is what that is. The hammer is dropped, right? When people are really practicing social distancing, closing out big events, restaurants and bars, and you can only go to do essential chores or go to grocery, things like that. It really does flatten the curve, and we're going to have a couple of charts to show how that's actually happens in other countries. And the shutdown or the hammer period might be 3 or 7 weeks, and it really helped just basically move flattening it so it doesn't overwhelm the healthcare system, but there's still going to be lots of people who will catch the disease, this virus, and in a way it kind of helps build the herd immunity. So there's a little bit positive sign to that, but there's the dance period is what's afterward. When maybe the government is opening it up for businesses to open, schools open, and you're going to start, still have to be maintain this control so you still have to practice social distancing, still not going to be able to have these large gatherings, and there is a cost to the economy, which we're going to cover in the next couple of charts. But we are already in Washington here. We're roughly, is it the second week now or the third week now? It's kind of passing by so quick. So we're already start seeing some of the numbers that are positive news, like how is coming down a little bit. This is when the cases say they all start at the same time, and these are different states. These are different curve, and the dotted line is kind of what the exponential curve looks like. We start seeing in some states are actually start already seeing slowing of the daily growth rate. I think the U.S. is, I think from on Tuesday, Neo's chart was showing somewhere in the 34% daily growth rate in cases. I think a check this morning was somewhere around 26 for the whole country. And for Washington, I think I saw it was more like a 5%. So we had the first case in the U.S. So I think our governor may not be the first state to really do a shelter in place and other more extreme hammer measure, but we already start seeing some kind of reflection point that we're in. So that's positive news, I think. Anyway, anyone have anything to add? Feel free to jump into it. So I do want to bring up this case. This one is for South Korea. They also had an outbreak, and they practice social distancing, the hammer, all these measurements. But the biggest thing is they do a lot of testing, and the testing really does help. By identifying and quarantining people who have the virus, really helps us control the spread of the virus. And so they're kind of in this dance phase. But one thing to notice, they didn't have to shut down their economy. They still, a lot of their schools still open. There's some schools just shut down, but a lot of their schools are open. Their business is still open, and that's because they really take it on early, and they do a lot of testing. That's really helped them. I think we might be little bit late to do that, and we had issues with getting cases out to the community. But then I think it will pass. It looks like for South Korea it took 3 weeks, so I'm hoping that in a few more weeks we should start seeing drastic decline in number of cases. It's my hope anyway. Let's see if that will happen. And so one thing we want to be aware of when, I think administration was trying to get people back into work by Easter. I'm not sure that exactly is the best move. We really should let the cases tell us whether it's good or not. As an example, in Hong Kong, they practice social, all this thing that we talked about. Lots of testing. People are social distancing themselves. They largely control it, but when they go back to work, and kind of see kind of second wave, so to speak. Is when people start, commuting with public transportation and going to work together, sharing workspace. This may not necessarily be because people are going to work, but because maybe there are also people flying back to Hong Kong from Europe and maybe the U.S. But that's something to be to be worried about. So that's about all the cases. I just want to throw this meme here. This is in Chinese, but it's translated. It says, in the world history, it's the first time where you don't have to do anything, just sit at home and watch TV, and you can still save the world. So keep practicing. So distancing it'll be light at the end of the tunnel. So now I'm gonna switch gear to talk about the economic impact, at least some of these projections. And the projections are projections, and they're what we know today. And I'm just quoting these data from CBRE. While CBRE probably was more of the optimistic ones compared to was Yardi and Eminem. Was it
Marcus Millichap.
Marcus and Millichap, thank you. Yeah, so here's what they say. They think that it is short term is brutal, kind of sum it up. Short term is brutal, medium term is positive. And as far as their projection goes for Q1 GDP is going to take a 1.5 point hit, and Q2 is -6. Now, I'll put an asterisk in it because there will be other entities and in financial institutions have their own projections. But they're optimistic overall. They think even it's going to grow in 3% in 2021. So this is already, you see this note data is already outdated. I think this chart was put together like this early Monday before the jobless claim numbers out. Now I think we have 3.4 millions or 3.3 million files. So it's definitely a lot bigger than what some of these economists or these companies are anticipating. And so then landlords would just basically have to adjust forward, have to deal with a foreseeable wave of financial or economic vacancies. Yeah. All right, so kind of just talking about those number a bit. This is a couple of tweets. It looks like every other day, another entity will come out with their numbers, and each day it got worse, right? You got first JP Morgan has a -14%, and then Goldman -24%. And it looks like 2 days ago, I think Morgan Stanley put 30.1%. So we're going to see a near-term huge impact to the GDP. And so this is again going back to the initial jobless claim chart. So we just got this chart fresh off the press today, and it just shot up. But you also kind of look at how the previous recessions from the trough, basically the lowest point with the fullest employment, to the I guess the peak of the initial claims. Usually it takes, number of months, right? Even the shortest cycle was 4 months during the Great Recessions, and there was just no in between. We just shot up right there. So it sounds pretty. So I just want to interject and put in a little cartoon, hopefully lighten up the mood a little bit. Due to all these things that are happening to the economy, the Fed, the government are trying to help, so they slashed rate to 0. So I thought this cartoon is kind of interesting. And the next one is helicopter money, right? You can see the Fed is printing and basically dropping helicopter money. Well, at least this cartoon was maybe a couple of days old. By the way, I love the cartoonists in Hedgehog. They're doing a great job. But it looks like I think we start seeing some effect on the stock market today. With at least for the last 3 days, it has been gone up for quite a bit. So it looks like the Fed, or at least the stimulus package, is taking effect. So I think this chart. Oh yeah, Blue Jay, how about you can walk us through this chart?
So I'm gonna give a very kind of basic overview of the 2008 recession compared to the current crisis. So the Great Recession was caused by defaults in the subprime mortgage market. So basically, when you get a mortgage from your local banks, they bundle your mortgage with other people's mortgage and sell them all together as an investment product to big investors. So these are called mortgage-backed securities. So the big investors buy them, and because traditionally mortgage is considered a very safe investment, and they sell these securities to other investors in the global market. Now, if you recall, right before the Great Recession, before 2008, there was that massive housing bubble, right? So and a lot of people defaulted on their mortgage during that time. And as a result, the mortgage-backed securities became basically junk investment. A lot of the big investors who bought these products went bankrupt. The most well-known case is Lehman Brothers. Everyone knows about that. And now the problem was that these companies were so massive, and then the financial world was so globally interconnected that this problem really slowed down the whole global financial market and had a domino effect through all aspects of the economy. And then the resulting recession lasted for 18 months, and 8.8 Americans lost their jobs. And one thing we need to understand is that in 2008, average American household was not financially healthy to begin with. They had lots of debt and had a low savings rate at 3.6% of their income. So when this recession hit, everyone was busy paying off their debt or finding new jobs that they didn't have that extra money to spend, which is needed to stimulate the economy. So this decreasing spending contributed to the recession and lasted for such a long time. Now, let's compare the situation to that at the beginning of 2020, which is just a few months ago. People learned their lessons from 2008 and was doing better financially. Overall household debt was lower, and on average, people were saving more of their income. However, despite all that, we were not ready for this coronavirus crisis. The situation right now is just very different. At the core of the current crisis is the fear of the COVID-19 virus, which is causing a decrease in human and economy interaction. Products are not being made, businesses are slowing down or shutting down, people are making less money, and therefore they have less money to spend. And without adequate intervention, decreased spending will lead to layoffs, which will lead to further decreased spending, and it will create this vicious cycle. So to put this into perspective, in 2008, it was a very gloomy time with a lot of people losing jobs. However, despite all that, people still traveled. They went to restaurants, they went to shopping malls and all that. But now, all that is really stopping. So imagine what kind of impact this will have in the future. And I'm really sorry for sounding so depressing, but this is the reality that we're facing. But in a lighter mood, I do have hope that our government and the Feds have learned a lot from the 2008 recession, and now they're implementing whatever they learned really fast. So hopefully they can dampen the damage to some degree. And I'm also hopeful that there will be some type of endpoint for this virus. The researchers should be able to come up with a treatment plan or a vaccine that's going to stop the virus. So I want to remain hopeful, and I'm just hoping that this happens fast.
Mm-hmm. Yeah, like to your point, I think the Fed has already, and the government of the $2 trillion, which is unheard of, right? And they basically buys everything, right? Doesn't matter whether it's municipality bonds, corporate bonds, even bailout for lumber company, airlines, and Boeing, and all these different businesses, small businesses as well too. So they definitely are doing everything they can try to help the situation.
I think they're kind of smart about how they distribute the $2 trillion. From what I heard, they're not just giving all to people. I mean, some are going to regular people, but some are going to going towards unemployment paychecks. Some are going to help give out loans to businesses and things like that. So they're being very delicate about how they distribute all that money.
Yeah.
Just want to add one thing is because American consumption comprises a huge proportion, over 2/3 of the U.S. GDP. So as Vijay highlighted, as opposed to the Great Recession, people now aren't really going to spend money and to help have that underlying foundation. So it is different than the last crisis, and hopefully the stimulus package will, with the small business loans and the individual, and there's a lot of caveats with all that, but hopefully to put it optimistic into it, hopefully that'll at least mitigate that impact on the consumption side of things as part of the GDP makeup.
Mm-hmm. Yeah. Anything else that you want to add, Vijay, before we keep going?
Nothing for me.
All right. Well, thank you for sharing this. Yeah. So it looks like the household, like you said, the household debts are a lot less than in 2008. And it was really a housing bubble, right? And so this time around, I mean, the virus really did its effect, but coming in, I think even in fourth quarter GDP-wise, we see businesses already slowing down, and they're also not putting in the profits into increasing productivity. A lot of them go into the stock buyback, which prop up the historic high valuation for a lot of the companies, and also a lot of companies take on debts that are, just kind of becoming zombie company and barely making their debt payments. So I think COVID-19 really exposed that weakness. So that's here we are today. So, but you end up a positive note. I mean, the government is doing a lot to help, and so U.S. policy packages, well, I think it will do a lot to help with the recovery. This is again a couple of days old, but it looks like a stimulus package just out, and I haven't actually read it and see all the details. It'll be interesting to see how long it takes for people, for you and me, to actually get a check, and also for those who are the owners, what is it kind of relief do we get when our tenants are not paying rents? So we're definitely sympathetic to them, but also can we get a forbearance, and is that going to impact our business or our personal credit? So I think that's something that's still see, or maybe if anybody on the call have read it, feel free to chime in and talk about it in the chat box. Happy to talk about that. So, all right. So let's see. So another kind of fun cartoon. I mean, the U.S. economy is sick, and they need. Here you go. Here's $1 trillion. No, actually, should add one more trillion. It's $2 trillion to recover a sick patient. And kind of going back to what you talked about, it was a housing bubble, and this is what this chart shows. And the left is really showing the supply of housing. As you can see, back in 2006, right, is a huge peak on the number of properties, houses and single and multifamily built during that time. And then after the Great Recession, we didn't build that much more properties or units. Both, multifamily is just basically catching back up, but the single family space was tight, is still tight, really short supply. We can also see on the right side, kind of showing the relative health for the real estate market. You can see that while this is a green line is the mortgage debt service, so it's actually a lot less as a percentage of their income. So a lot of, just because of all this great deleveraging that happened in the real estate sector, banks require a lot more to lend you money, and so that kind of is a result of that. So I think people all along knew the next bubble isn't going to be caused by real estate, and I think it is really a corporate bubble. So will the healthy sector, which is a really healthy sector, still going to be impacted even we have really tight supply? So I think that will remain to be seen, but I think we already start seeing signs of that. First, this is like a little ticker chart. This one on the this is, I think, just released today. Some of the indicators, financial indicators of the health of the market. And we saw initial jobless claim come down here. But also what's on this chart is the mortgage applications has gone down quite significantly, maybe because the loss of jobs or maybe just the uncertainty of the market. It's definitely taking really dampen the mood for either just people not holding off of their purchasing decisions, or they just simply lost their jobs. I think Bowick, in the beginning, we mentioned a little bit about that. So you want to fill us in on what are you seeing in the title world as you do handle a lot of transactions? Have you seen a lot of how big is the drop is? Boy, are you there?
Yeah, I'm here now. Hey, Henry.
Yeah. Okay. Yeah. Yeah. Fill us in on what you seeing in the closings, in the transactions you're dealing with.
For closing, okay. So we can discuss in different angle. Firstly, talking about new listing, new transaction. So of course, at this moment, starting today, we are not supposed to go out. I mean, the real estate agent. So that's why no more new listing. So many listing agent, real estate agent, they are going to keep the new listing after the shelter in place order is gone. So that means at this moment no new listing. Another thing is we're talking about the listing. Another thing is about the buyer. The buyer, significant amount of buyer, they are worried about the market. So that's why some of the buyer, they are too scary to go out to, I mean, not today, before today, they are too scary to go out to see house. And also for those people who already have a mutual of the contract, I would say this month, the file back out from pending significantly much more than any months before. So some buyer, they are worried about the market will slow down or economy will slow down later. So that's why they want to back out from the deal right now, and then probably some of them, they may wait for the market to going down and then buy again. Some of them actually worry about their ability to keep to support the new house, because they themselves don't know. I mean, can they keep their job, keep their income? So that's why combined together, they make a lot of people scary about the market. That's the buyer.
Right.
So,
yeah, I heard stories of people are just they're willing to just lose their earnest money to
Yeah.
walk out from some of these transactions. So it looks like the residential market definitely taking a hit as well.
Yeah,
So,
and also I have some new construction project. Yes, and then even the builder, they are worried about can they fulfill the agreement to finish the construction, because right now they are not supposed to. I don't think the construction they can keep working on that. I think this morning, or I forgot, yesterday or this morning, I received a notice from MBA, the Master Builder Association.
Mhm.
The master is no, I mean uh, I forgot it's M for what. And actually, it's a builder association. They actually mentioned that all the construction they're supposed to stop right now. So because of the for those transactions already pending, I have some file pending for closing in the middle of next month, April. So because now they cannot keep working on their construction. So of course next month they are not going to close the transaction on time. And also, of course, the government inspector cannot come to inspect the property for the what I call for the
right.
occupants.
The inspection, yeah.
So all kind of thing will happen. The buyer may take that opportunity, saying that you cannot fulfill the agreement to finish the construction. They may back out from the deal. So there's some of the builder they kind of worry about that. Oh yeah, last night I have a discussion with them. So that's the new construction is kind of worried.
Yeah.
Yeah.
It could have a rippling effect too, right?
Yeah.
Yeah, and the builders have to carry pretty high, construction loan as well too. So a lot of these are pretty heavy leverage, especially for single family homes. There's a lot of people borrowing hard money for construction too. So
Yeah, so, I mean, one builder actually he mentioned that similar to last time when the market crashed last time, uh, he said that probably some builder may go bankruptcy this time if they cannot finish the project on time because they still need to pay a lot about construction interest, and then if the market keep dropping, then they are going to have trouble.
right. Yep. Thanks for sharing that. Okay, so let me keep going. So, real estate market update. I think we talked about it pretty much already. Kind of looks like people are pulling back their listing, or people are backing out of deals. Especially weakening in other sectors, not just residential. It's hospitality and retail. Obviously nobody's going on vacation right now.
Hey, Henry,
yeah.
I got some good information today from some of the brokers in San Francisco. So just to kind of add, if I can, what they're seeing, and so this is from Colliers, it's a national firm. So I think this probably represents across the country, but pretty much deals that are in contract, in negotiations, everything's on hold until the coronavirus stabilizes or perceives to. In San Francisco, even on commercial properties, they've halted all tours, and that was actually before the quasi quarantine. Mm-hmm. And then what I found kind of interesting is that the institutional lender rates are up, or rather at 4.75. Mm-hmm. 3 to 5 and 5% for 7 years, which is starting to put downward pressure on pricing. But at the same time, lenders are like proactively contacting lenders to make sure that they can work through their debt. Whereas in 2008, I know that when I was doing work, everything seemed to be caught off by surprise, and it was kind of like, what let's see here. Oh, and then of course this was kind of fun that if you're a multifamily owner, property owner, you're kind of in the catbird seat if you happen to have a stabilized multifamily property with below market rents. Then you're kind of set, which would be kind of optimal. And of course those are oftentimes the properties that we're looking to buy.
Right. Yeah, you had to put off all pretty much your value add plan, or at least you can still do value add, but not necessarily get the rent that you're looking for.
and then on the retail, they're thinking the mom and pop retailers are really going to get hit hard on this because they don't have cash reserves, and then they're waiting on government support, which is going to be slow and partial. The retail development is really slowing, kind of coming to a halt. Neil said something interesting in his, I don't know, I guess it was this week, that he anticipated construction pricing dropping, and that he planned to renegotiate a lot of his contracts, construction contracts. I think that's worth kind of noting. So, and then this is and this is just like the harsh world of real estate. But in San Francisco, everybody knows the Transamerica Pyramid. It's the Bryce-Roney Treat building. So that's some are in contracts, non-refundable money. I think the sales somewhere around $1 billion. It includes a side building, but now that's being retraded. So, and I think that's, one, it's kind of fun to know, but two, I do think there's a trickle down effect, that happens, from like a big building like the Transamerica Pyramid to your, $5 million, garden style apartment complex somewhere in the secondary market. So,
because it's harder to get along right now. I heard from other sponsors are saying that the banks are kind of freezes up a little bit, or at least they require a much bigger reserve. I know Vivek can maybe talk to that, but he's not on baby duty. I remember seeing an email from Vivek. Did we are you available?
I'm back, Henry. Sorry for the delay. I've been seeing Fannie having their requirements jacked up a lot. I think previously they needed anywhere between 9 months to 6 months of lender reserves. I think that's been bumped up to 18 months for loans below $6 million.
Oof. 18 months.
But the good thing is, if you can show 2 quarters of good DSCR, meaning your performance is good, then they credit you back 6 months of reserves.
Okay, they just want to hold it in the escrow and see how you perform, and then credit.
I think it's
back
really
to you.
trying to make sure that they're not lending on assets which are set up for failure. They want to see that the at least 6 months of performance before making sure that they have released all the extra funds.
Right. Yeah. And what are you seeing as far as maybe the LTV, loan to value? Has that changed?
I've been speaking to both bridge and agency. I don't think anyone's doing 80% right now, at least in the smaller markets. They have considerably reduced the loan to value to be more close to 70 or 75 at the maximum. But for hotels and other recreational things, lending has just come to a massive stop.
Yeah, but it's all harder to stop, right?
Yeah.
Mm-hmm. Wow. Yeah. Hopefully we'll see that maybe easing up a little bit with the Fed's buying up everything, all the bonds and all the pumping money in the market.
That's true. Yeah. I think one of the participants, Mark, also commented that CMBS is completely shut down. I think it's come back now. But then Freddie has increased the requirements to 12-month reserves and definitely much lower leverage.
Mm-hmm.
And thanks for the contribution, Mark.
Yeah, thanks. Yeah, I mean, imagine what is that going to do with the price, right? As the buyers are not able to leverage as much, it'll be less buyer.
That's right.
We're going to see a decline in pricing, pretty sure.
It all depends on how long this situation goes on. I think lenders currently are very nervous about lending to sponsors because they don't know how much liquidity they can have, and also they don't know if they have an investor to buy that investment. So they are going through a lot of churn right now, and the whole stimulus package might definitely add a lot of. It might calm down those markets, but time will only tell us.
All right. Thank you. Thanks for sharing that. All right. Okay.
Right.
So yeah. And this chart, I think we saw it from Neil's chart, it just kind of showing which sector get hits the most. And I just want to summarize it without going into detail. Looks like senior housing, I guess due to the cases in here in my local town, the senior home, they got hit with the virus. And student housing, people have a school closed, so they're going back home. And malls and retails are being hit at second hard, offices as well. Looks like even apartment took a hit. What's surprising was I think manufacturing home, which also took an even deeper hit. That's really interesting. It should be more resilient to recession. But medical offices are in self-storage are the strongest in the pack, and besides cell tower and data center, there's not going to be a whole lot of people operating these assets. So I guess self-storage would be a great asset class to get into. All right. So kind of preparation. This kind of segment is kind of talk about maybe we all could share, even the audience can share back with us. What are things you are doing, and to kind of help cushion this current situation. And so first, I just want to share real quick just what owners are doing to prepare, and this is from CBRE or maybe from other site. Basically, they all kind of follow the same kind of guidelines. If you're owner of apartments or even single family homes, just a lot of communications with your property managers or even your lender. Just kind of see if they have any forbearances but then it'd be interesting to know kind of what to get everyone's opinion. When would you think that's the first thing you do, or maybe that's the last thing you do? And then also kind of just communication with your other tenants. If a case happened in one of your unit that you did clean it, make sure to let everybody know so that you're not perceived as a what they call it, like a cluster that happens, and people want to flee your apartments because they perceive you're not doing enough to help with the cases there. So just follow these processes from to make sure that you have timely disinfect the property. But I think so this is kind of where I'm asking for audience input as well, and but kind of what are you personally doing to in this situation? Is there any feedback? Maybe Peter, Jan, any suggestions or things that you're doing personally right now? Kind of from a finance standpoint. Mm-hmm.
I can share a little bit knowledge about the forbearance because I just called my lender yesterday. So I don't know whether every lender offer the same. So you should check out with your own lender. So basically, my lender said I can go to their website to apply for it. There are, I think, 3 options you can choose. One is obviously depends on your application to prove how much you are affected by this coronavirus, right? So if they approve, you can apply for 6 months, up to 6 months, defer paying the mortgage. But when 6 months ends, how do you pay back? There are 3 options. One is, okay, you pay everything you didn't pay for the 6 months, and then you pay it one time. So in 7th month, basically you pay 7 months mortgage altogether. That's one thing. Another thing is that basically you pay the amount of 6 months that you didn't pay, but you pay it in maybe a couple of months, not at one time. Another, the last option is called, I forget, basically you change the terms. So basically you extended your terms. For example, if you didn't pay for 6 months, but now you are extending your terms. Let's say you have 30-year loan and you already pay 1 year, you have the 29 year left. Now it's 25 0.5 year. So yeah, then you need to re-sign the contract. But the good news is that these will not affect your credit score at all, and then all these options will not change your interest rate. Yeah, so that's pretty much it. But I encourage everyone to call your lender to see what offers they provide.
Well, that's good to know. Yeah, I also like that you call them before the next rent is due on the 5th. So get in front of the line. Before everybody is calling the lenders.
Yeah.
That's a good suggestions.
Yeah, I've always been when in particular when news is bad or the waters are rough, to be very proactive with any stakeholder in the real estate chain. While not big in volume, but we have 3 vacation properties, in pretty nice places, and one's getting hit pretty bad, and one hasn't been hit bad, and so these areas are contemplating shutting down. All the rental agencies are contemplating shutting down. Making any rentals. So that would shut down the all revenue. And so as that relates to everybody in the that's connected to each of these homes, whether it's gardeners or this, that, or the other, reaching out to them very proactively, which is a very small scale to what Yan's talking about, as in terms of the lender.
Mm-hmm. Okay. All right. So I'm going to share some of the advice from a local in kind of close to Seattle, an investor, and come up with some of her suggestions. So we can kind of go through them real quickly. She has some rental property, so she wants to fill vacancy as soon as possible. This is before the shutdown, so this might be a bit old, but I guess she's right. Because of lockdown, it's so much harder to find apartments. So if we can be proactive and try to get them leased out early, and if your city's not already in shutdown mode, but if yours is, and maybe see if we can renew the leases, and if they're within 6 months, start talking to them, and maybe even offer them some sort of concession, which I have done on my own too. Within 6 months, I've already had my apartment manager contact my tenants and give them a discount to see if the kid, stay, in the property for another year. Because I don't want to do that when everybody is cutting concessions, and be the one more proactive and be the first to do it instead of be the last to do it. Also, kind of maybe other kind of ways to reduce your expenses, possibly. I think for single family space, I think I can still proceed with my refinance, which I already have set in motion already. The rate hasn't fallen that much, even though fund theft rate is 0%. It'll take a long time to even get to us, and getting that low a discount. But yeah, it looks like start to refinance early, even though maybe just getting in all your documents in before locking rates if it comes down. But you might also want to do that in case there might be a layoff, either your job or maybe your tenants get laid off. And so I would definitely get in the application early as possible. Requote insurance rate, yeah, you can do that. I think, yeah, making sure, let's see. The rest is for other things, but there's also some tips for individuals as well, talking about refinance your automobile payments and other ways to cut costs out of your daily budget. So, yeah. All right, so let's talk a little bit, change topic, recovery prediction. So what the other influencers or economists are saying? What's the crystal ball? So first, I want to talk about the bears. People who call them perma bears. People who always kind of have this, I would say, a pretty not doomsayer, but they kind of have a very negative view of what's going to happen, and this is Harry Dent on the left side. He's I might have came to fame because he predicted the last 2 crash although he was calling 2012 was crash, but it didn't happen. So his reputation kind of came down quite a bit. But if you listen to his interviews and podcasts, he's always talking about this great recession that's going to come, was bigger than anything we're going to see. But he said, and a positive note, right, he talked about that this lockdown, once implemented, 2 to 4 weeks, the cases are going to come down. It was actually reassuring from him, who's always talking about this negative view of the economy. He's predicting there's a crash of 45% in S&P, and at this time, writing is down 32. I think it came back, quite a bit today, the last 3 days, and they're going to bounce. And then before I go to a more longer downturn, just a piece of advice from him on the in real estate front is he thinks that the medical offices are recession proof. He likes apartments, and he thinks commercial properties are bad. So especially the high end markets. So you can listen to his podcast. And the next guy I want to talk about is Neil Howe. He's a demographer, and I think he's more known, for those who are not familiar with Neil's work. He and William Strauss wrote the book called The Fourth Turning, and he's the actual guy that coined the term millennial back in the 90s. So this guy talks about I can just read this quote. Basically, he thinks about that there's a cycle in human history, about 80 years, 100 years. You go into crises to getting back to normal, to boom and then bust, kind of a cycle of 4 seasons. So he thinks that there's a fourth turning, and we're in one, which is kind of the era of destruction, war, revolution, all these things. They're terrible, it sounds like, before I get rebuilt again. So he thinks we're already in one since 2008 from the Great Recession. And I think 2020 is just the catalyst. So these guys are very negative view of the world. But let's talk about maybe other people who are not as pessimistic. I want to bring up Neil. Have you heard from his Tuesday webinar? He's talked about, he was pretty bullish, or from his recent interview. He's think we'll just have to wait 3 months or maybe 6 months, and then maybe we'll get a discount on properties. He thinks he's going to be bouncing back in a very sharp V shape. This is what I heard, maybe interpret differently from what he actually said, but I kind of hear there's a lot of optimism in his voice. But even still, it isn't going to be the same as it came out of. Today's apartment at 95% occupancy, he doesn't think that we're going to come back at the same level, because there are people who has lost a job because the businesses, especially the small business, would have closed. So those people are not going to be rehired immediately. So one thing I thought was kind of interesting, what he said about 2 different types of asset. One is the need, and the other is the want. So the need would be the apartments, right? Those are the people who need a shelter, a roof over their head. But want, like hotels and other assets, are more discretionary. So he's going to see different change in the cap rate. So it's going to favor a lot more for the need-based asset. And he was also very bullish about the medical offices, kind of like what Harry Dent was saying. He even talked about that he might even get these empty offices and convert them into medical offices, which is very fascinating. So also, I want to ask what the audience here, or maybe the panelists here, if you have any kind of prediction, or what you think is it going to be? Do you think it's more like a V shape, U shape? Any kind of comments on that? You guys are quiet. All right. Anybody here? No? No. Okay. So how about this? I'll share with you what other guys, the big operators, are saying. So these panelists were, I was on, oh wait, hold on. I actually saw someone responding in the chat. All right, we got a V from Sheldon. Thanks. Any other predictions? All right, so we got a V. So I think there's a lot of other operators. These guys, by the way, they all have upwards of 3,000 or 4,000. Someone has 10,000. They were all on this recent I guess, what do you call it, fireside chat with James Kadasamy. And so it looks like there's a couple of V's there, and one maybe a U. As what's interesting is Brian Burke. He's called it the Nike shape, where it's going to sharp drop and then going to slow climb back up. And I'm going to actually share also some notes I took, which I thought was interesting. And I'm going to read them, some of these anecdotal notes and how they what supports their claim this is going to, or their view of why is what it is. So Vinny says a V, you know, I think it's a really good opportunity. And the Fannie are being, have lots of capital there, so he's not worried. It's the Fed's printing so much money. Rich, he's basically saying, kind of recounting his experience from 2008 recession. There was one round layoff, second round layoff, and third. And he said one more would be dead. It was really tough. But this one, you know, kind of comparing to this one more like a hurricane, like a natural disaster. He's not, maybe not exactly the same kind, might be a lot more quicker. But he says the loans ceased for the last 2 weeks. You're gonna be wait a while before to see what normal is gonna be. And especially now, he can't get the same level of leverage. He's even seeing a lower LTV, like around 65%. So these guys are actively doing deals still. They're not basically telling completely stop. It looks like that's what they're getting from their quotes. Brian Burke, he survived 2008. He has a tough year, but he says this time around real estate is fundamentally sound. So he's thinking that he might be able to. He's actually, sorry, in the last round, there's a lot of loss devaluation, but he doesn't think that is going to be buying them at 40 cents of a dollar. And he's again more the Nike swoosh shape because of the short-term impact, but kind of slow the recovery. Ivan, let's see what he says. And pretty much the same. The Fed is buying everything. Everything is being bailed out. So he's saying a V. Same thing with James Kadasamy as well too. So it looks like a lot of them are saying it's going to be a V-shaped recovery. Also, let's see. Yep, I think kind of you can make your own call, but looks like I think the operators, I mean the market are currently still cautiously optimistic about the market. So, which brings out to the next topic, which is a quote from Warren Buffett, where he says, "Be fearful when there is greed, and be greedy when there is fear." So, and I also like to bring up this quote, which is it's actually from John F. Kennedy, when he says, "When written in Chinese, the word crisis is composed of two characters, which is danger, and the other represents opportunity." So, maybe question to the panelists: Have you think about it still a good time to buy, or how maybe how long will you wait, or maybe how you might change your underwriting? How about James and Vivek? I want to hear from you guys. Also, what are you plan to do in the next couple of months?
Yeah, so we are obviously taking into account the situation, and we're kind of addressing it in two different ways. Yes, we're still looking because not completely shutting our doors per se, but we are adding a extra layer of conservatism to our underwriting. Namely, that takes the form of zero rent growth and an extra vacancy factor, because certain employment industries would be impacted more so than others. And so if we have a diverse tenant base in terms of employment, then we wouldn't necessarily one-to-one match the ratio of joblessness claims. So, and then the other side is more of the sort of strategy side of things, and we're placing more or less of a focus on actual acquisitions and more so systems building and relationships being with both brokers, strengthening those ties, as well as with our investors and really educating them. We think it's a great opportunity for education, because we have lots of deals that we've said no to. And here's the reason why, and particularly in this case, is educating them on how taking into account the situation with the rents and the vacancy, this is why it could have been a good deal. But being conservative with this situation here is a new situation, the new data, the new performance of this asset, and this is the end result for investors and sponsors, and it just doesn't fit the criteria per se. And so that's the modified kind of criteria that we move forward with. So we're going to stick to that and move forward in the coming months. It's something either it doesn't weathers a storm a little bit more resiliently than other properties, and or is combined with maybe a discount perhaps of some degree, then it would certainly be considered.
Right. Yeah, I mean, no one predicted this one from coming, right? But when we underwrite, we really try to be conservative and take into account what would be from maybe not rent is not going to grow 5 or 3% year to year every year.
Yeah. The Phoenix is 6 and 7%. We'll see. Phoenix isn't hit as hard as California, but we'll see how that goes for the next few months.
Mm-hmm. Yeah, I think Brian Burke was saying he's in his underwriting he's putting 0% for the next 2 years.
Not out of the question.
Yeah, but what he was kind of I found a lot of parallels when he's underwriting. He's basically not been able to buy a lot of deals because he always put a conservative lens on. He always uses cap rate reversion, which made it really hard for him to find deals, as we can attest to that as well too. And finally, he can be proved right this time. So,
yeah, sweet victory.
Yeah. All right.
Just to add to James's point, we are doing all of those as well. The other thing that we're keeping a constant eye on is the changing lending requirements. Because in any deal, the biggest investor is a lender. You have to make sure that all those parameters and criteria are being met. One thing that I do hear from the lenders, especially in the last 2 weeks, is they want to make sure that the sponsors can perform, both from operational point of view, also the deal closing point of view. So lending has become more selective. It did stretch a little bit over the last 2-3 years, but it's become more selective, and they are choosing quality sponsors over just doing deals.
Mm-hmm. Yeah, that's a good point. Yeah. All right, so I do have something to add. I think just from hearing from other sponsors, it looks like maybe the hotel and and maybe even medical offices are going to be great buy opportunities. Apartments still have really strong demand. People still need a roof over their head, so I think it still can be a pretty stable asset to come. And self-storage as well, because people are not going to, because they're paying their self-storage rent by the credit card, and they're not necessarily want to, not pay their self-storage and then go get a truck and move everything, and they're still going to find a place to move everything else to. So those are typically more of a class where we're really resilient to recession. But the single family space might be taking a hit. And I think we kind of answered the question was, for some of you anyway, is to continue to just be conservative and make sure you're planning to capitalize on the deal to go forward. So I think this might be the last of the charts. So this kind of also talk about some other upcoming events that our listeners and audience could go and sign up for. Say both Yardi and Marcus Millichap are putting together events coming up soon in the first week of April, April 1st and 2nd. So interesting to hear what what they're seeing. And also Neil and getting another town hall with Hunter Thompson and Ben Lepidus to talk about their viewpoint from a experienced operator, what they're doing. I think this might a lot to do with the asset management side. I'm not sure exactly, but it looks like there'll be a really good discussion there. So that is a wrap for us. I think if you are near our neighborhood, and feel free to contact us, and we're happy to chat about real estate or what's happening to your investment, or talk about the strategy as well. So just feel free to reach out to us. And I'm going to see anything else. Yep, I think that's it. Let's is there any questions from the audience? Actually, I am going to, so what I'm going to do is I'm going to do hit unmute. Let's see how I do that. But feel free to put it in the question box as well. Oh,
Henry,
sorry.
can you
Okay.
go back to
Yep. Go back to here. Yep. Come find us. Yeah, let's chat. I was gonna go and change to everyone can talk, but I don't know how to do that. So try to figure out how to use effectively on Zoom. Okay. All right. All right. Guess no questions. So I think I was going to leave it up here for a minute. And thank you for everybody to join us. We're going to do it again next month. In April, we're usually the Thursday of every month, the last Thursday of every month. Yeah, if you find us on Facebook, I think we're going to have to talk about advertise it there as well. But we'll have these meetups, local chapters, where some of us here are the co-organizer for your local chapters. We're not having a face-to-face meetup yet, but hopefully when things get back to normal, we can actually come out and have a face-to-face meeting. So, all right, everyone, thank you so much for you guys, and thank you for the panelists sharing your insights.
Thank you, and good night, everyone.
Yeah.
Thank you and have a good night. Stay healthy.
Good night. Stay healthy.
Thank you much, everyone.
Thank you.
Thank you, everyone.